All right, everybody. So we're going to get started today with Schedule E and Schedule C income. For those of you who may not know what Schedule E and Schedule C are, basically Schedule E would be your rental income on your 1040, so on your borrower's taxes. So if you have a borrower who is basically collecting income for a rental property or several rental properties, it could be one, to as many as they pretty much have, they will carry a Schedule E. For a Schedule C would be your self-employed borrowers. So this will be, a lot of the times it would be either an LLC or a DBA, or pretty much just someone who is basically making income as a self-employed borrower. So today we're going to go ahead and get started with reviewing the Schedule C. Well, we're actually going to do both, of course, but we're going to get started with Schedule C income. When we're looking at Schedule C income, a lot of us tend to, pretty much, go off of what the borrower says. I have borrowers that are truck drivers, especially, and they'll tell me, oh, I make, um, they'll say I make 200,000 a year. Well, yes, they do. Most of the time they of course do make that income, which would be in their gross receipts here on line item 1. But we do have to make sure that we're taking a look at these items for review before we start finalizing their income. So you want to take a look at line item 4, which is your cost of goods sold, I'm sorry, your line item 12 and 13, which would be your depreciation and depletion. Line 24B, which would be your deductible meals. Line 30, which is your business use of home. And you also want to look for business miles when you're doing any type of calculation for your Schedule C income borrower. So those are super important when you're doing, because that is what your underwriter is going to look at. We did have a situation where we had a borrower who was bringing in funds to close, and with their funds to close, they had about $36,000 to $38,000 in the bank, but their cost of goods sold was approximately $18,000 a month. So unfortunately, we couldn't use those funds for closing funds. So that's something that's why you want to definitely take a look at that, because they do have to hold a specific amount of money if they're writing off cost of goods sold. What can be, like a vendor. So sometimes you have vendors like, for instance, in that case was a vegetable vendor. So what he would do is he, of course, had to sort himself with supplies, and then he would sell them. So any type of vendor that will basically come in and have to purchase supplies to sell, those are the type of vendors that usually write off costs of goods sold. So when you're looking at that, you want to make sure that, just as an example, let's say you have a borrower who is, has writing off 125,000 in cost of goods sold. You're going to end up dividing that by 12, which is of course your months of the year, and then you're going to multiply that by 3. So what they have to have on hand is a minimum of 3 months available to cover that cost of goods sold to run their business. So in this case, it would be, the 125 divided by 12, which is 10,416 with 67 cents. And you're going to multiply that by 3, which will give you a total of 31,250. And as I mentioned, this borrower that I had this situation, they didn't have sufficient funds to be able to use those funds to close, as well as run their business for the next 3 months. So we do want to make sure that, we have that availability when you have a borrower who is writing off cost of goods sold. The next thing that you want to take a look at, of course, like I mentioned, is depletion and depreciation. You actually can give this back to your borrower as income. So if they're writing off any type of depletion or depreciation as deductibles, you can reimburse that to the borrower's income. So let's say your final line item is, let's say your final line item 31 is $12,000. Of course, that would show that they're making $1,000 a month, which would not give us a lot of income, of course, right? But let's say that their depreciation and depletion for their business is, another 30,000. Well, now you're able to actually give that back or reimburse that to the borrower's income. One thing you do want to make sure that you're doing is you're deducting meals. So it is your deductible meals on your line item 24B. So that is a deduction. That's something that's commonly missed when we're actually doing income review. So if this, this number may seem not like a big number but when your borrower is pretty much a self-employed borrower and you're not able to extract any more income, this can, be a do or die. We did have a situation where we had a borrower who had deductible meals and it was not deducted. And unfortunately, it brought our DTI over 50%. And of course, we had to figure out either getting a cosign or we had to figure something out, right? Because this can be a do or die. So you do want to take a look at your deductible meals. In this case, of course, what you would do is on our income sheet, and I'm going to show you guys, it's going to go ahead and do the math for you. And again, we can share that income sheet with you guys. So I just want to go ahead and show that to you. Expense use of home. So the business use of home, you actually can give this back to the borrower as income. It is a deduction, but you can give reimburse this back to the borrower. Now, it does have to have some type of consistency, though. So you just want to make sure that if you're going with 1 year or 2 years taxes, that your borrower actually has been using this. And in all cases, especially when you're using a self-employed borrower, you are going to go with worst case scenario. So you're always going to go, let's say they made more money in, excuse me, 2020 and less in 2021, you're going to have to use worst case scenario, which is 2021. So again, business use of home, you actually can use it as income. Now, it is for using a portion of the home for administrative and management activities. So just remember that it does have to be some type of administrative or management self-employed borrower. Your miles here are basically going to be calculated. It's every year is a little bit different, so you can definitely check with us. This year, it's 26 cents per mile. So when you have a borrower who is writing off business miles, so not commute miles, not other miles, it would be your 44A miles that you can actually go ahead and reimburse to the borrower's income. The way that is calculated, it's basically you will grab the miles and you'll multiply it by the cents, which in this case will give you an additional income of $2,561.52 per year. Again, if you go back and you say you have this deductible of meals of $29.50, well, now you have something that you can actually give back to the borrower as well for income. So it's always good to take a look at the entire income that your borrower has on their taxes so that you're able to actually accurately calculate their income. And it's pretty easy actually with Schedule C. It's very different when it comes to 1120s, and we are going to actually host a class for that, which is another type of self-employed borrower. But when it comes to Schedule C, this is the way that we take a look at your borrower's income. We're looking at, of course, your line item 1. We're taking a look at your line item 4, which is your cost of goods sold, your 12 and 13, your 24B, and your line item 30. We are going to start with your line item 31, of course, but we're taking a look at all that, and your line items 44A for any borrower who is actually writing off miles. So when it comes to income calculation, we're going to go ahead and go to a separate sheet just because I like to actually do it. Sorry about that. Let me exit this. So I actually like to do the actual sheet with you guys. 1 second. We got lost on me here. So the tab here that you're going to have is basically going to be, again, for 2020 was 27 cents a mile. For 2021, it's 26 cents. I will let you guys know because, of course, this rate always changes. But this is how the calculator looks. And as you can tell, basically, it's going to break down your line items actually for you. So this is actually something that is going to be super easy for you guys to be able to find the line items, because it's going to let you know what line items to look for. Line item 31, which is your net profit and loss. And now you're going to go back and give back the income to your borrower. So that's where this is going to calculate that for you. Now, it does have some little X's here. So basically, if you're going with 1 year self-employed, you're just going to delete the X, and automatically it's going to give you the number of months that it's calculating for you. So if you're going to be using both years, you just place the X back here, and it will automatically show you that it's 24 months being calculated. So now let's just say we're using that same borrower. Let me go ahead and get you some taxes here. One second, guys. I want to put them side by side so you guys can see them. And it'll kind of be tiny, but I just want to go ahead and show you guys. 1 second. All right. So basically the way we're going to do it here is this borrower is a coach. So they do coaching from home. So it is administrative work. So as we mentioned, it is administrative work that they are doing from home. So let's just say for right now, we're just using 2020. We're going to make up numbers for 2021 because I don't have their 2021s. So the way we're going to start is you're going to start with your line item 31. So we're going to place here the 93,117. Your line item 6, if you have a line item here, it's usually canceling itself out. So if you do have one, and let's say it's $1,200, but then you're going to place it again as a positive, if you notice, it's basically going to go back to your same number. So when you do have your line item 6, if they do have any other type of income, it's automatically going to cancel itself out. So now let's say we do, right now, we don't have depreciation or depletion. So let's just skip that part for right now. We did have miles of approximately, so what was it, 98.52. So now this is already calculating it for you. It's already giving you the plus depreciation of 98.52 times 27 cents. And it's giving you a total of 660. Sorry, 2,660. You can actually give amortization back. Now, you do have to have it here on your other expenses broken down, but it does have to state amortization or casualty loss. So it's usually on your expenses. So that's another expense that you can give back, but make sure it's actually itemized here. So usually it's in this section, but you cannot give it if it's not actually itemized, and it will read as amortization or casualty loss. In this case, we do have a borrower who does have business use of home of 3143. And as you can tell, this is now going up, right? So it's already giving you that income upwards. Now, the reason it's not giving you a calculator, it's because as you can tell, we do have an X on 2021. So it's trying to finalize that. If I delete it, it's going to start giving me my income. Or maybe not. It doesn't want to cooperate.
Jael, where did you find the 1,200 for?
Oh, no, it was just an example.
Okay.
Sorry, I'm going to delete it. So this is just an example that if you do have a line item 6 on your other income showing you here, if there is another income here, it'll actually calculate it for you. Just give me 1 second, because for some reason, this one's not cooperating with me and it's not giving me the calculation. So let me get another income calculator open for you guys. I want to make sure you guys are seeing that it actually adds up and everything for you guys. And for some reason, that one didn't want to cooperate today. All right, so we're going to go ahead and start again here. So we're going to use, of course, your line item 31, so 93,117. We're going to go ahead into depreciation and depletion. We have none. Our miles was 98.52. And then our business use of home was 3143. We have no amortization or casualty loss here, so we're going to skip that. And we do have deductible meals of 2950. Now, in this case, it's not calculating it for me. Now I just realized this because we do have to have a current year, right? So let's just make up numbers for our next year. I'm going to go lower because I wanted you to guys see how it's basically going to calculate for you. Right now, it's giving you a 12-month.
Yeah.
Ugh.
Highly.
Yes, sorry. Go ahead and ask Carlos. It's muted. Sorry.
Why you mute me?
Sorry.
It's in the I just noticed the 2950 you put on the wrong field, should be below.
Oh yeah, sorry.
Andale,
Okay.
pues. Bye.
Okay, thanks. Bye. So as you guys can tell, you'd want to put it in the right field because it is a deduction. So you want to make sure that you guys are placing it in the right field. And now I realize why it wasn't calculated. My bad, guys. So the reason why I wasn't calculating is, of course, if you start placing your 2020, we do have to use 2 years. So we do want to make sure that we're placing it in the correct section here, right? So if we can go ahead and start, I'm gonna make up numbers for 2021. So let's just take away. And the reason why I want to go lower is because I want you to see that if something is lower, it's actually going to the calculator itself is going to give you your worst case scenario at 12 months here. So if you notice, I just put $92,000.
El otro decía, el link, mira lo que dice, 12.6. So
I'm sorry, guys. Some people are logging on and not muting right away. The other, if you put less, your calculator is automatically going to go your worst case scenario of declining months. If I put more, of course, right now at this point, I have more income up here. So let's go 96. As you can tell, it's automatically going to give me a 24-month average now, because now my income is not declining. So that's the cool thing about this calculator. It's actually going to go ahead and give you the appropriate income calculation. Let's just say this was less, but a lot of my other deductions were more. So basically, it's going to start working with you based on your calculations, right? So it's going to give you, so if you notice this, as soon as I went ahead and gave it more income on the casualty loss, because this here was less, this 95.69 and this was 95.9, it's going to automatically calculate at 12 months. But if I'm giving my home business use of home more, now my income is higher for 2021, and therefore now it's calculating at 24 months. But we still haven't given a deduction of meals. Let's say it's less. Well, now, it's still going to keep it at 24 months. But let's say it's more. Let's say it's 32.50. Now it's reduced it back down to 12 months. So that's the cool part of this calculator. It's always going to give you your worst case scenario. It's never going to give you the average of 2, because at this point, if you're averaging the average of 2, even though this is fairly close, it's going to be wrong. So you want to make sure that you guys are actually doing your income calculation correctly. If you're using 2 years, you're marking these both, and you're taking a look at your bottom total number and going worst case scenario. Of course, if it is a best case scenario, let's say they made 94,500. Their miles was almost the same, at about, let's say 10,000 miles. Their meals and deductions was approximately the same. Their business use of home, and their meals and deductions were approximately the same. Of course, it's going to give you that 24-month average, and it's going to average both. It's going to give you your lower year plus your higher year. So you don't want to go with the current year, because if you do go with the current year, then your income is actually going to be wrong in this case. So it's always going to be the worst case scenario. In this case, our worst case scenario is averaging both years, even though the current year they made more money. Now, the only way that you can actually go with your current year, if you do need that, is if you do go 1 year LP. Do keep in mind there is a little bit of differences as far as your pricing and all that good stuff. So you do want to make sure that you're checking with your price desk. I do want to throw that out there. It just depends. It doesn't mean that it's going to be a huge difference, but there is a little bit of a difference. So you do want to make sure that if you must go LP, that you're actually pricing out your loan correctly. Anybody have any questions with regards to Schedule C income? No, I explained it good. I will be sharing this income calculator with you guys if you want. I do separate the income calculations only because, if you can tell, we as underwriters do have a big, vast income calculation sheet here. So we want to make sure that we're giving you the appropriate ones for the appropriate clients. If you guys don't have any more questions, we're going to go ahead and move on to Schedule E income. I know it's funny because when I first started with this, I was so scared that I was going to mess up. And after I started learning this, like I wanted to do them all the time. It was, it's weird. I don't know. I just like breaking my head a lot. So Schedules E income, you guys do want to make sure that you're always taking a look at, and when you're reviewing your taxes, what you want to review for. Let me pop this over here to show you guys a full page one first. And we are going to do the income calculation as well. So this is what you're looking at when you're looking at a Schedule E income. Again, this is your rental income calculator. And what you want to review here, of course, is the highlighted items, right? So I'm going to break that down for you guys. You want to take a look at the type of property. And it is going to show this here. You're going to see, your number amounts. So you want to look at your type of property, your fair rental days, because remember, guys, not all the time there's these borrowers rented the whole time. There are times that they just bought it and maybe had to repair a lot of stuff, and it could have taken them 6 months to repair it, and they only rented it for another 6 months or 3 months or something like that. So you do want to look at your fair rental days. You want to look at your line item 3, your rents received, your total expenses, which is your line item 20. You want to look at your line items 9, 16, 18, 19 for the items that you're going to give back to your borrower, your line item 12 for mortgage interest, and your line item 14. A lot of people skip through the line item 14 for repairs, and I'm going to explain to you why you want to make sure you're taking a look at that line item. It is very important that you guys are actually taking a look at that line item because you actually can give back specific repairs to your borrower. And I'm going to get into that right now. So, like I mentioned, take a look at type of property, fair rental days, rent received, total expenses, insurance, taxes, depreciation, HOA fees, mortgage interest, and repairs. So we're going to jump into it. So the income deductions that a lot of people use, of course, is they're always going to use what they're paying for. This is the total amount of rents received. This is the total expenses that they had. But there are items that are not considered in actual expense, right? Like your mortgage interest, your insurance, your taxes, your depreciation and depletion, and your HOA fees. So we can give those back. So do make sure that here it does say HOA fees. I have seen it where it doesn't, but if I know the property is a condo and I can match my dues to this, you can give that back to your borrower. So just make sure that you guys have that proof for your borrower. So repairs, the reason why you guys do want to make sure you guys are taking a look at your repairs is because you actually can give that back to your borrower. How? By a one-time extraordinary fee or repair. I had a situation where I had a borrower who had rented a property, and when the tenants moved out, he was told by the city that there was a tree where the roots were starting to cause foundation issues. So he had to have that tree removed. It cost him a lot of money. He was able to get it a little bit cheaper, but it did cost him a lot of money. Also, the front gate for the home had, the previous tenants had destroyed it. So you do have issues where tenants will pretty much mess up a rental. So this particular borrower had almost $15,000 in repairs here. Normal repairs are not going to be so high. So my question to my borrower is, hey, why did you have so many expenses on line item 14? And he told me, well, I had to do this and this and that when the tenant moved out. Oh, okay, perfect. I can give that back to that borrower as a one-time extraordinary fee or repair for that property. And the only thing, of course, is you want to make sure you prove that. How do you prove that? Receipts. Luckily, my borrower kept his receipts, and he had the tree removal fee as well as his, he had to put a new wrought iron fence in the front. So he had those receipts that I can prove to my underwriter that, he was basically, it wasn't just a made up fee, of course, right? So he was able to get that money back in as a one-time extraordinary fee or repair towards that property. So you do want to make sure that if you're seeing a large amount here, I mean, I've seen different amounts. It can be anywhere from $1,500, $2,000, $3,000. But if you're seeing very large amounts here that is not consistent within their taxes, make sure you guys are asking, because you can actually give that one-time extraordinary fee back. So now I'm going to go ahead and get into income calculation for that. Does anybody have any questions so far? I want to make sure that I'm not jumping through quickly. Another thing you guys want to make sure you guys are looking at too is your ABC order here. You want to make sure that you guys are making sure that they don't have more than one property. So if they do, we do actually have two separate ones. We have an individual one. So we have a calculation for one property that you guys can compare. Usually what I do, and I'm going to be very honest, I use a one sheet and I calculate years. So I do, like, for instance, this one can be my 2020, this one can be my 2021, because again, just like your Schedule C, you're going to have to go ahead and calculate it that way. So this will be, let's say, for my property, one single property. This is for multiples. We do actually have one if you want to do multiple ones on one calculator. So it's pretty cool. It holds up, you know, a bunch of properties on here. So let's go into the individual. And basically, you know, for your processor, you know, you can go ahead and put the address up here. So what I normally do is, if I'm going to use this one to use a 2-year history, I will just go in and put 2020 here. And then 2021. So that way, when my processor takes a look, or my underwriter takes a look at my income calculation, and just keep in mind, guys, your processor is going to double check your work on here. So that's the cool part, is that you will have an you know, 2 income calculations sheets that can be presented to your underwriter. So once we start entering here, so again, this is going to basically tell you what to look for. It doesn't actually give you the line items. I will go ahead and place them in for you once I extract this. But you're going to do rents received, which is going to be your line item 3. That's $21,600. And then you're going to go all the way down to your total expenses. So initially, we're going to start with the plus and minus of the actual rents received. So the total expenses this borrower wrote off was $21,968. And then now we're going to start giving back the items that we can give back to give the income calculation. So in this case, line item 9, insurance is $1,404. Your mortgage interest, which you can give back to your borrower, is $5,432. Excuse me. Your taxes, line item 16 at $2,791. So this is here your homeowners association dues, your HOA dues, which in this case is $5,760. And we can see here that in this case, the borrower did put it as HOA fees on line item 19. As I mentioned, there are times that when things are being written off, it just depends on the tax preparer. Sometimes the tax preparers will put other, but again, if you can identify that this is HOA dues, and the way that you can, of course, again, you're going to ask your borrower for, you're basically going to ask your borrower for their HOA invoice, and that's going to help you calculate that so that you can make sure you can match that up. So now we're going to go ahead and give them depreciation and depletion, which is your line item 18, and that's $4,901. And again, here is where your one-time extraordinary fee expense would be. So this is a casualty loss. So again, it is saying there must be evidence of the nature of the one-time extraordinary fee. So again, the evidence can be, you know, receipts, paid invoices, anything like that, that shows that they actually have the evidence of that. So you can place that there. Now, so right now, what my rental amount that it's giving me here, my result is $1,660. This is monthly. So just keep this in mind, guys, when you are placing this on your verification of mortgage on your Encompass, this is the amount you're placing in as your rents, the $1,660, because it's already dividing it here by 12 months. Now, let's just say this was not 365 days and this was only 90 days. Well, we know that's 3 months. Once we change this, now you can tell that our rents have increased. Let's just say, for instance, this was, some units. A lot of the times we do have tax preparers, and it's just, and I'm going to be honest, it's mostly about 90% of the time, our tax preparers are going to actually place units in one line item. They usually don't break it down by unit. I rarely see that. But as you can tell, this has given me a higher result. Why? Because our market rents was not 12 months, it was 3 months. If it was 6 months, again, it's going to calculate it for you by month per the expenses that you are breaking down from here. This is why it's important for you guys to look at your fair rental days, because it is going to calculate that for you. Now, if in this case, I just want you guys to know this calculator does not give you your worst case scenario, simply because it doesn't have that specific option for you. But if you have, let's say 2020, when they collected a little bit less rents, I'm just going to go ahead and start making up some numbers here, or maybe the expenses were a little higher. Maybe taxes went up, mortgage interest. Let's just make up some numbers. Usually this doesn't go up a lot. Depreciation was less. So, all right, I wanna make it less just to kind of show you what you can do. So let's say this income here for your results was less. Again, if your 2021 is less than your 2020, you're going to have to give them this income of $1,583.33. If your income is more, then what you're going to end up doing, let's say this is reversed, and the income for 2020 is actually 2021. So what you end up doing is you're going to end up actually going ahead and averaging this out. So this is just like your taxes. If it's 24 months and this is the reverse, then you're going to get the 1583.33 plus the 1600, and then you're going to divide that by 2. Because remember, in this case, you don't want to divide it by 24 because you're already dividing it by months. So we divide that by 2, and the income we're going to give the borrower on our Encompass income is going to be $1,621.66. So that's, of course, if this was 2021 and this is 2020 and 2021 was higher. So again, you cannot give them the higher, you have to average. But in this case, like I said, you're going to divide it by 2 because this is already calculating it for you by month. So it's already giving your monthly income calculation. The cool part of this calculator is it does actually give you a portion where you can input your PITI, your taxes, your insurance, and all that good stuff, and it's going to give you a separate result. The only reason, and this is just me personally, I don't use this section is because keep in mind that your Encompass is already going to have the your Encompass is already going to have this income portion or this deduction portion that you're already inputting, because when you're going to attach your taxes, your mortgage, it's already going to deduct that. So this is the only reason I don't use that, because you don't want this number to be lower, and then that's because you're already deducting the items that are actually going to be deducted in your Encompass. So you don't want to double deduct it, right?
I have a question.
Yes, absolutely.
Hey, so that number that's there as income, is that used to calculate the debt service ratio?
So the debt service ratio is actually for you're talking about like a DSCR loan. That's going to be a little bit different. And I can actually get you guys an income calculation for the DSCR. This is more calculating a Schedule E borrower on a on an income that they are actually reporting on their taxes.
Okay. All
Yeah,
right.
so the debt
right.
service is a little bit different because that's more of a purchase. We can use the income calculation of previous, but remember the debt service ratio is based on the actual property they're purchasing. So they're not usually using any additional income.
Got it. Thank you.
Mm-hmm. Does anybody else have any questions with regards to income calculation for Schedule
So
E or Schedule C?
in a nutshell,
Yes.
again, this is Jose again.
Yep.
In a nutshell, if I'm understanding correctly, the calculators are going to be used or in place to help eliminate a lot of the common mistakes, correct?
Yeah, so basically what it is what we're trying to accomplish is for our, even if it's, sometimes we've invited some realtors to see our loan officers and realtors to see the common mistakes that do occur when we're calculating. And again, honestly, I'm being very, very honest. I made a lot of these mistakes as a new LO, and even as having been in the business for a little bit, I had, times where I made mistakes that, for instance, on the portion where the amortization, where I mentioned to you guys in the Schedule C borrowers, I made a mistake and looked at the income of my borrower broken down here as part of these deductions, and I added it as that deduction, that other expense here, that 27A, simply because I misread that the amortization where it says see attachment Schedule C, because that income calculator stated that I can add that back, right? But I didn't read the entire, because it does give you a little notation here, and it was another income calculator. This is why we use this one, because this one's a little bit more, it just breaks it down and lets you know. So I've made those mistakes. So in catching myself to make those mistakes and speaking with my underwriter, this is why we set up these classes, is to kind of like, throw out there the common mistakes that we as loan officers or realtors make. Of course, realtors don't always do income calculation, but I know a lot of us wanted to learn. When I was a realtor, I wanted to learn, So yeah, our whole goal is to kind of just help you guys be able to see, your incomes. So by the time it comes to processing, you're not getting those like, oops, sorry, we can't calculate it. Do you know what I'm saying? Anybody else have any questions?
Yeah, thank you.
Absolutely. And again, I can send this out to you guys if you guys want these income calculators. Like I said, I do extract them and clean them up a little for you guys. They're super good income calculators that I like to use because this is what our underwriter uses. So what better tool to have than, the tool that your underwriter has, right? Let me see here. Let me look at sorry, I'm looking at, okay, so in regards to the results, section 28, you're talking about Schedule C? Schedule E, okay, one second. Hold on, because I had a question. I'm going to read out the question to you guys too. All right, so this one says, the question says, in regards to the results to section 28, the income reported is for the current year is more, you will need to average the income of the current. And if the income is less for the new year, you will need the current. Yes. So if this is your 2021 and your income is less than the previous year, you're going to use your current. If let's say this was 2021 and this was 20 and the income is more, you'll average. So you'll basically add your 1660 plus 1583.33 and you'll divide that by 2. Because again, this is basically already breaking it down for you by months. So you'll just average that. So if your current is more than your previous, you average. If your current is less than your previous, you use your lowest of the 2. Yes, Omar. So we normally go ahead and record all these, and I can share the link with you where all of our classes are at. Perfect. So does anybody else have any more questions? Normally this class is a little bit shorter just because it is a little bit more easy to just kind of show you the income calculations. But if anybody doesn't have any more questions, I can give you guys a minute. Don't be shy. No? All right, guys. So thank you guys so much for attending. Again, I can go ahead and provide you guys with a link to this recording as soon as it's available. I will go ahead and share this. Please email me, guys, JY Munoz or Munoz actually, because it doesn't have an A in it, at icorelending.com so that I can send you the income calculation sheets. I look forward to the next class with you guys. Thank you all so much.
Thank you, Jael.
Thank you.